50 feet below the streets of Manhattan sits a high-security vault that very few people even know it exists. Inside are the physical paper certificates for most every stock that you think that you own. When you hit buy on an app, you aren't actually getting the stock. You're getting a digital IOU from a secretive entity whose name is on almost every single paper stock, and they are called Cede Co. For 400 years, the market has run on the logic of paper, and in 1973, we immobilized those papers in that vault to make digital trading possible. But the actual ownership never really left the building. But on December 11, 2025, the Securities and Exchange Commission quietly gave the green light for this system to be dismantled. They issued a no-action letter that officially opens the gate for a new way of owning assets. The Depository Trust and Clearing Corporation, referred to as DTCC, is the plumbing of the entire US market, which does have a set deadline of the second half of 2026, and this is when this all goes live for everyone. We're moving from a world of paper gatekeepers to digital gateways. In this video, I'm going to map out the exact investments that I'm going to be making to capitalize on this $100 trillion shift. And no, my focus is not on crypto, but it happens to be the companies that are the backbone of this entire new infrastructure.
I do believe we're just at the beginning of the tokenization of all assets.
The 2026 deadline isn't a suggestion. It's a production rollout. So you're either positioned before the switch actually flips, or you're buying after institutions have already front-run the entire move. So why would the world's biggest banks invent a system just to burn it and go back to paper? Because Wall Street never moves without an exit strategy. This is the two-way bridge. Institutions don't just upload a stock to the internet, they keep the physical asset at the DTCC as a baseline. As for the digital token, it's just a high-speed vehicle for trading. Think of the token like a digital twin in a high-speed flight simulator. In the simulator, which is our blockchain, you can fly at Mach 3, you can pull 9 Gs, and trade positions instantly because there's no physical friction. But the flight was never fake. The simulator is hardwired to a real multi-million-dollar jet that just happens to be sitting in the hangar, just like the stocks are in the vault at 55 Water Street. When the digital mission is over, then you burn the simulation data. The digital jet just vanishes from the screen. But the real jet, like I said, it's still sitting in the hangar, ready to be handed back to the traditional pilot. Tokenization doesn't replace the jet. It just lets us fly at speeds that the physical world could never allow by using a digital twin. So you might be asking yourself, why even bother? And to understand that, you have to look at the trapped capital that's in today's system. Currently, clearinghouses act as a central counterparty, stepping between every buyer and seller to guarantee that if one side fails, then the trade still goes through. And in order to manage the risk, they require banks to park billions in margin and to guarantee funds. It's essentially just dead money that's just sitting there in a vault for days, just in case there happens to be an error or someone defaults. Now, on a different path, if that asset is in token form on the blockchain, it moves with atomic settlement. So in layman's terms, this means that the payment and the asset transfer are all happening simultaneously and instantly, and that eliminates that settlement gap where most of the risk is living today, meaning it can pay dividends every second instead of every quarter, or it could be used as collateral for a loan that you might be making at 3 a.m. on a Sunday night. It moves from being this static piece of paper to a living piece of code that exists every moment of every day. So here's what this means for the markets. Essentially, capital efficiency begins to explode. When BlackRock can move $2 billion in tokenized treasuries instantly, instead of having to wait 3 days for a settlement period, I guarantee you they're not doing this for fun. They're doing it because it unlocks billions in trapped capital that no longer needs to sit idle as a safety buffer. The World Economic Forum estimates $20 billion in annual savings, and that's just from deleting the manual record keeping and the paperwork that just bogs down the system. That's the entire profit margin for mid-tier investment banks.
The reality is that behind the scenes, there's a lot of plumbing that intermediaries and inefficiencies that people are not aware of it. So if you think about what tokenization is, it's essentially upgrading the ledger where capital markets run to a better ledger technology that is public, that is distributed, cryptographically secured, etc., which will improve how people transact with securities.
But first, let me introduce the sponsor of today's video of 21 Shares, which is recognized as one of the world's leading crypto exchange traded product providers. Their mission is to make it easier and more accessible for everyday investors to gain exposure to digital assets. Having followed the crypto markets for years, I've seen several investors hedge against the erosion of the dollar with a small allocation of crypto within their portfolios. And I have to say, I appreciate that 21 Shares aims to bridge the gap between traditional finance and crypto. They offer fully collateralized and registered investment products traded on global exchanges, including exchange-listed products that track major digital assets such as Bitcoin and Ethereum. 21 Shares maintains a deep focus on transparency, compliance, and the investor education. You can easily check their website for the fact sheet or the insight section to learn so much more. If you want to stay ahead of the curve on all things crypto, subscribe to the 21 Shares newsletter to get market insights and trend breakdowns. The link is down in the description, so go ahead and check out 21 Shares today. And of course, this is not financial advice, and all investments carry risk. Now, here's how the exit would work. A major bank needs to move that stock back into a legacy 1970s account, or a regulator might demand it. They perform what is called a burn. The digital block is permanently deleted from the blockchain. Poof, gone forever. It is now impossible to trade on the chain ever again. That deletion triggers an automatic conversion order. It tells the vault at 55 Water Street the digital version, it's completely dead. Release the old physical entitlement back to the old ledger. But that just happens to be the efficiency play. The real money isn't flowing into digital stocks, well, at least not yet. Instead, it's flooding into the $10 trillion alternative asset market. Private equity, credit, and money market funds that were once trapped behind weeks of manual paperwork are now moving onto these digital rails. And the vast majority of that capital is settling on one backbone, Ethereum. Data from rwa.xyz shows that over 65% of all tokenized real-world assets are running on Ethereum rails right now.
Wall Street is going to innovate on the blockchain over the next 10 to 15 years. But we're talking about tokenized equities, tokenizing credit, real estate, reputation, and eventually intellectual property.
JP Morgan isn't waiting for adoption. They're actually forcing it. Their Connexus network, like I said, is already moving $2 billion every single day on the chain. They aren't trying blockchain. They're using it to run the bank's global treasury to unlock the trapped liquidity that we've already talked about. Even corporate treasuries are betting their entire future on this type of backbone. Bitmine is now the largest fresh money buyer of Ethereum in the entire world, with a goal of owning 5% of the total supply. They are adding Ethereum to their balance sheet almost every single day. But here's the warning that everyone needs to hear. Yes, Ethereum is the backbone, but it's not a sure bet. We happen to be in an era of infrastructure wars, where institutions want the speed of the code, but the control of the entire vault. JP Morgan built Connexus on a permissioned version of Ethereum. They want the efficiency without the volatility. And then there's Goldman Sachs, which is spinning out their own platform of GSDApp because they want their own rails. They don't want to rely on someone else. This happens to be the battle for the next 50 years of financial infrastructure. Retail investors like us are betting on public protocols, while institutions are building walled gardens. You need to understand which side is going to win before you actually allocate a ton of capital. So like I said, if the world's largest bank is moving $2 billion a day and the largest Ethereum treasury is cornering 5% of the supply, then how exactly do we play this? Here's the reality. Institutions had roughly 6 months of a head start on this type of trade, and the SEC's no action letter just dropped on December 11th, 2025. JP Morgan started to build out Connexus in 2020. BlackRock, they launched BUIDL in March of 2024. By the time that retail investors begin to hear about tokenization on the mainstream financial media, the easy money's already going to be gone. The deadline that is coming up in the second half of 2026, that happens to be when this goes from an institutional beta test to a production rollout for everyone. And that's our window. So how am I going to position my capital for the 2026 deadline? I'm leaning towards a 70-20-10 allocation. I'd put 70% in the banks that control the infrastructure, 20% into the pure play toll booth, and 10% into the speculative protocol bet. This happens to be more in line with my asymmetrical investment approach that you've probably seen and heard in my other videos. That 70% is the institutional moat. JP Morgan is moving $2 billion every single day through Connexus already. Goldman Sachs is spinning out GSDApp as a standalone entity, inviting other banks to trade on their rails, turning themselves into a software and fees business. Supporting plays are NASDAQ, which is selling tokenization software to other exchanges, and the custodians, BNY Mellon and State Street, are building the digital vault connections. To me, these are not moonshots. These are more safe bets because they're infrastructure owners that are capturing fees without a lot of protocol risk. Moving on to the 20%, think Securitize, ticker SECZ, expected to list on the NASDAQ in the first half of 2026 at roughly $1.25 billion valuation. Now, here's what they do. Securitize is the infrastructure company that tokenizes real-world assets for all these other institutions. They're an SEC-registered broker-dealer, transfer agent, and fund administrator, meaning that they handle all the legal and the technical plumbing in order to put traditional assets on the blockchain. They happen to be BlackRock's infrastructure partner for the BUIDL fund, $2 billion in assets with $100 million in dividends paid out. They control 20% of the entire real-world asset tokenization market. BlackRock, ARK, and Morgan Stanley are rolling 100% of their equity into the public company. No one is selling at IPO. If tokenization actually scales to the $2 trillion Standard Chartered projects by 2028, Securitize is the toll booth that's collecting fees on every single transaction. That happens to be the highest conviction pure play in this space. Now on to the last 10%, which is the speculative edge, where Ethereum hosts roughly 65% of the tokenized assets. And true to form for Tom Lee, he is projecting extremely high numbers for Ethereum, where he's expecting it to hit between $7,000 and $9,000 in early 2026, which I think is completely bonkers, but then again, he's been right an awful lot. So we're just going to have to all wait and see. Which brings us to BitMine, which is a leveraged version of Ethereum. It's a corporate treasury buying and holding Ether, and they're targeting 5% of the total supply. Well, right now, they're sitting on $3 billion in unrealized losses with massive share dilution. In my opinion, this is for aggressive speculators that are betting on major growth in Ethereum. This 70-20-10 allocation really matches my conviction. Institutions control tokenization, not crypto-native protocols. To me, the banks are going to win either way. Then there's Securitize with an upcoming IPO, which is going to win when volume begins to scale. And Ethereum only wins if it becomes the dominant settlement layer, and that's the least certain outcome out of all of this. But here is my hard rule. Price exposure is not ownership. In 2026, I'm going to avoid any tokenized stock that doesn't give me a security entitlement. That happens to be a direct legal claim on the asset at 55 Water Street. If I can't verify that, then I'm probably not buying it. The entire financial system is being recoded right now, and you can either be a user of the new system and pay all the fees, or you can be an owner of the infrastructure and you can start to collect on them. Most retail investors are going to hear about tokenization in 2027 when it's already priced in. But you're hearing about it now, 6 months before that 2026 production deadline, because you happen to be watching channels just like this.
Tokenization is a freight train. It can't be stopped. And I think eventually it'll eat the whole global financial system.
The difference between early and late on infrastructure plays, it's never 20 or 30%. It's the difference between Securitize at $1.25 billion pre-IPO and Securitize at $10 billion post-adoption. This happens to give you plenty of time to research these plays, build your positions, and get in before the crowd ever shows up. But overall, it's time to do your homework right now. And just a reminder that you can see my exact positions in my free newsletter linked down below. But remember, I do this for educational purposes, and this is not financial advice. As always, thank you so much for watching.